All right, good afternoon, everybody. I am going to spend time today on three things. First, what are the factors that drive our market? Second, how do we think they're going to evolve? And third, what does that then mean for our market growth expectations, regionally and globally? But to get us started, I just want to set the context of where we are today. If you look back over 15 years, and I'm conscious many people have studied this industry for a long time, three distinct cycles. We had a long-standing premiumization cycle, there was COVID acceleration, and most recently a consumer reset that's been largely affordability driven. Despite recent pressure, especially in the US, spirits, including RTD, has been in long-term growth. Through this period, and especially most recently, RTDs has been a really significant growth contributor, which you can actually see quite clearly by the divergence of the two spirits lines on the chart. Premium beer, also in long-term growth. I'm going to spend most of the time today on spirits, including RTD, given that's the majority of our business. Question for us isn't, is this market's going to grow? We're confident the market's going to grow. Question much more is, what's driving it? And making sure we take that understanding to inform our strategy and inform our plans. For us, there are three fundamental drivers of market growth: demographics, wallets, and behaviors. Demographics, put most simply, how many people and who are they? Just a point of nomenclature, you'll see through the slides either LPA, LDA, it's legal purchasing age, legal drinking age. If populations grow, it expands the LPA consumer base. As people age, they drink differently. We track both on a market-by-market basis. Wallets, how much money do people have? Alcohol, ultimately, is a discretionary category. So if you see affordability pressure, you see people getting squeezed, you see discretionary spend come down, alcohol is impacted. On the other side of this, though, in markets where there's economic growth, emerging middle class, category participation broadens, we see premiumization, we see tailwinds. Again, we track both on a market-by-market basis. We use publicly available macro data, but we'll also get custom pulls to really get under cohort dynamics, especially age and income. On the behavioral side, we study all sorts of different things. The three primary things we're looking at are the evolving attitudes to socializing and alcohol's role within that, growth of GLP-1s, and the rise of convenience. We use a range of studies, but we do here have proprietary research, especially against the attitudes to socializing. We field 17 markets twice a year, and some of the information from that I'll share with you today. Let's start with demographics. Without question, demographics are a tailwind. Information on the left panel here is looking by region at go-forward population growth expectations. I draw your attention a moment to the US number at the top. This is forward-looking at 0.5%. This year, forecast to be 0.6%. Interestingly, as recently as 2024, it was 1.2%. That drop is primarily due to net migration. In fact, historically, immigration has been at least a 50 basis point tailwind in the US. So if immigration policy were to be in a different place in the US, we would expect that population growth number to be different. The other thing I'd say, looking at the left panel, it's not just, is the population growing? Are they engaging with our category? Spirits penetration atop across leading markets remains at or above pre-COVID levels. So people are engaged in the category. What we then look at is, well, how are people spending? How are they spending on spirits? How does that change by age? We look at the average, and then we look at the age brackets relative to that. And you can see this green corridor here, whereas the elevated spend against spirits, ranging from 35 through to 74. Interestingly, if you looked at this for just the whole of alcohol, you'd see it more condensed. That green corridor stops at 64. So we're quite confident from a spirits perspective, as populations do age, we do have that little bit more protection. Second, there is a lot of conversation at the lower end of the spectrum, and I'm going to talk about Gen Z in a moment. But interestingly, higher age cohorts, whether you look at a percentage of their spend out of their total expenditure, or if you look at the dollars they're spending, they are spending more on spirits, more on alcohol than they used to. So there's increasing spend per age cohort at the high end. We then said, okay, let's make sure we're tracking how the population's going to shift relative to that elevated spend corridor over time. What we show on the right is the middle 50% of the population, of the LPA population. It's the interquartile range for those who like statistics. The dark box is where we are today. The dashed box is where the population will move to by 2029. Punchline being not much, actually, not much shift. This moves quite slowly. But if you look where the populations are relative to where they're heading, we feel pretty good about where we're sitting as populations age. Let's, however, talk for a moment about Gen Z. The first thing actually I want to call out is in the lead of the slide. We look at LPA plus Gen Z. And I bring that up because it is important when we're doing the analysis to make sure we cut the right age cohorts. Especially in the US, quite a lot of data sources will have an under 25 age bracket. And if you just pile that in of itself, it will lead to some technical term wonky math in terms of what you're getting out from a result. So we really do make sure we hone in on the LPA plus consumers. If we do that, a few things. Firstly, penetration. Again, how are Gen Z engaging with our category relative to general population? Whether it's spirits or RTD, we see Gen Z penetration is higher than general population across a range of markets. We also look at how are they spending? What percentage of their total expenditure goes on alcohol compared with other age brackets? US example, answer, very consistently. We see this in other markets as well. They're not spending, once you account for income and expenditure, differently than other cohorts. And how are they actually consuming? To look at this, we blend intensity and frequency data. We've looked at 2026, so recent data, back to 2023, to compare what's actually been happening. You see in most markets, it has been increasing, so claim consumption is up. The interesting example here, obviously, is Australia. For those familiar with Australia, high inflationary environment, excise is linked to inflation, and actually there's pretty recent excise hike. It's hurting everybody, but Gen Z disproportionately. What we also look at is claimed moderation, and actually Gen Z are also claiming to moderate less than other cohorts, especially in the US. So switching gears from demographics into wallets. Without question, the most acute pressure, but very definitely more of a developed market phenomena than emerging. So let's talk about the developed markets. What we're seeing, if you look at income versus inflation, quite simply, it hasn't kept pace. For the last 4 years, we've seen income growth lagging inflation growth across markets like UK, US, and Australia. We've also looked at this by cohort, so really dug in to understand what's happening. As many know, low income have been struggling for a while across these markets. They're in monthly deficit. Their incomes don't match what they actually have to pay on regular expenditure. Higher income, bit more protected, but still protecting experiences perhaps within that discretionary spend. What's really interesting is in the middle bucket, the middle income consumers. About 12 months ago, those consumers in both the US and GB would have been in surplus. They would have had slightly more money per month coming in and going out. That has flipped in the past 12 months. This is a consumer group that's now very stretched, increasingly using debt to protect lifestyle, but they are feeling squeezed. Back in Q1, we actually spent some time out with consumers across a range of markets. And it was really telling in those conversations, hearing the trade-offs people were making about holidays, about socializing trips with friends, even about how they were prioritizing different house improvements versus what they might have done in the past. But what was also really interesting is they were trying to protect their engagement with alcohol. People were looking for happy hours to make trips to the pub more affordable. They were really looking at small formats, which you'll hear us talk about today, but it was really notable how people were trying to stay in the brands they love, but they were looking for a smaller format. And interestingly, when they were looking at RTDs, which many were, they were comparing to the price in the pub. And relative to a price in the pub or a bar, that RTD was very affordable. How have things changed since Q1? So I'm going to take you to the right side of the page. Q2 versus Q1, we have some data here about the net intent to spend. How is that changing? Now, clearly not helped by the situation in Iran. This is a US example. But the intent to spend on gasoline, way up. But essentials, whichever one you picked, you would see this picture. It's still becoming more and more of the wallet, more and more squeeze. Discretionary, getting squeezed more and more, and alcohol is within that bracket. On the flip side, as I said, emerging markets, different story. Income's outpacing inflation, solid amount of discretionary spend, and again, when we did interviews with those consumers, it felt like a very, very different world. So if that's where we are, I'm sure the question is, okay, developed markets, especially US, when is this going to get better? So I sadly don't have a crystal ball, but knowing that within the US, it's spirits ex RTDs that's really the segment that's being challenged, we dug in back through 25 years of data to figure out what patterns could we see. What was it that had greatest correlation across different factors? And what we actually found is if you look at that US spirits volume, year-on-year changes in that US spirits volume, it's quite highly correlated with consumer sentiment. We had about a 0.4 R squared. If you look at real value year-on-year growth, so really then you're getting volume, but you're also capturing price mix, we're capturing mix, stripping out inflation, even higher R squared. So there is a linkage, or historically for sure has been a linkage between sentiment and what's been driving growth of volume and mix in the US. Now, timing, of course, is then the uncertain question about, well, when is this going to come back? Macros need to come back, for sure. But as many of you know, there is also currently a dislocation in the US between macros and sentiment. There's other factors, geopolitical, domestic policy, and frankly, the fact that consumers just don't like inflation, that's all compounding. But we would expect, if historic correlation does hold true, that as these consumer sentiment pieces come back, we would start to see more volume and value growth come back into the US. We're not sitting around waiting for it. John will talk to you more about how we're planning to compete going forward, but this is a relationship we've seen hold true. Okay, I'm going to switch gears to behaviors. While the numbers do vary by market, we are definitely seeing consumers telling us they are claiming to drink less. A couple of things I'd call out, though. One, that isn't necessarily new news. That has been happening for a while. And second, what consumers tell us isn't always what they do. So this is one of those places actually where the proprietary research we have is very helpful to get underneath a little bit more of what has been going on. The middle panel is when we've asked consumers, okay, so why are you moderating? What is it that's causing the behavior? And without question, health and wellness related concerns are an issue. They're an issue across all the markets where we talk to the consumer. But interestingly, financial considerations also come up a lot as well. In the US, 26% of consumers are citing financial considerations. In GB and Australia, it's as high as 34%. The other thing for the US is probably worth dwelling on for a moment. Many of you may well know or have seen some of the Gallup studies. They actually ask all sorts of interesting questions back for decades, so if you've ever got a spare moment, worth a look. But the one we track a lot is around perception to alcohol. And there's a question in there about whether you think it's good for you, the same for you, bad for you. That hit an inflection point in 2015, and actually, starkly started to go, people thinking it's worse. Between 2015 and 2021, spirits per caps went up, RTD per caps went up. So even though consumers may have been feeling or perceiving alcohol as being worse for them, there was still a significant growth in the industry. The other thing we use our research for is to understand what are people's moderation strategies. And interestingly, people aren't disengaging with the category. They are using things within our category, our brands, to actually still go out and socialize. It might be 0.0, it might be lower ABV, I talked about smaller formats, RTDs. These are all things that consumers are looking to as ways to moderate if they do want to drink less. And clearly, as industry leader, we have an opportunity to lead, shape, and provide that choice for consumers. Let's talk for a moment on GLP-1s, because that's a question that we get a lot, and rightly so. Firstly, adoption. You're probably tracking this as much as we are, but data's much better in the US. We know around 10 to 12% today penetration. Expectation is that goes up somewhere to 20 to 25% by 2029. Europe, rest of world, the data's a little bit harder to come by, but we would assume, per the US, that it will grow over the course of the planned period. Perhaps more important than adoption, though, is behavior. What are we seeing? So to get underneath this, we use numerator data, which is purchase panel data. It's 100,000 households. The data we have here is across 4 waves, from January 25 through to January 26. And what does that -2 mean? That -2 represents the difference between people who were on GLP-1s and people who weren't. People on GLP-1s spent 2% less on spirits than the people who weren't on GLP-1. Right, that corresponds to the 4 on beer, the 5 on wine. But I think to understand this one, it's also helpful to take an edge case. So humor me for a moment, but assume 100% of the population went on to GLP-1s in the US tomorrow. That would mean all those people spent 2% less than they do today. But that is a one-time level effect, doesn't compound. Realistically, one number I'm definitely confident of today is it will not be 100% of people in the US on GLP-1s tomorrow. In fact, it's already 10%. And over the planned period, it's potentially an incremental 15%, right, if adoption goes from 10 to 25. If the impact stays around that -2, that is a manageable headwind. Now, of course, we monitor this very closely, but there are some more qualitative factors from all the research out there that also gives us confidence that we think it may well stay as a fairly muted impact for spirits. First, people are still socializing. At least 50% of people on GLP-1s still go to the pub or a bar at least once a week. People are protecting special occasions, and we know spirits over-indexes in special occasions. People who also tend to be pulling out the more habitual boredom, snacking, eating, and drinking. That's not where our brands and categories play. And I think, interestingly, just from a psyche point of view, people are sometimes creating occasions to go out. They want to showcase their progress. So there is still a socializing environment. And when they do go out, unsurprisingly perhaps, they're looking for lower calorie, they're looking for lower volume, especially if they're having some of the side effects that people report. And RTDs actually also do very well because people are looking for control. So speaking of RTDs, let's spend a moment on convenience. What we've seen, this is actually looking back 10 years in the US at occasions. Won't be a surprise to anybody. This growth of the third space, we talk about it a lot, but it has actually gone up 3x in the US in terms of number of occasions. And that means alcohol's not necessarily the center of the occasion, the same way as it would have been if you'd gone to the pub, but it doesn't mean people don't want to drink. They just need a format that's accessible, which is RTDs. Unsurprisingly, therefore, we're seeing RTD per capita growth significantly across many regions, and RTD as a share of total spirits remains pretty low. And even in markets like the US, where it is more penetrated, we all know that's a segment that's still growing strongly. So we think convenience will be a persistent tailwind, both to volume and to price mix. So stepping back across the trends, demographics, tailwind. Wallets, we do think significant near-term pressure in developed markets. Emerging markets, it's actually a tailwind. And behaviors, look, while there are some challenges, we also see significant opportunity. What I'm going to do now is switch gears and say, okay, what does that mean for what we're expecting market? And I want to be really clear, market, not Diageo, market growth to be by region over the next 3 years. So let's start with North America. Without question, North America will remain a challenging region through the next 3 years. Over the plan period, I did not press anything, and it has scooted to India. If someone could pull it back, or I can do it. Okay. 3-year growth, value growth for the US, we're expecting to be -2 to 0. While there is some behavioral pressure, affordability is the predominant pressure. As we talked about, we see correlation with consumer confidence and volume and value. If the consumer confidence piece picks back up, we would expect to see a comeback come through faster. Equally, if the comeback in confidence is also associated, or there is a simultaneous change in immigration policy to the data I shared earlier, we'd expect that to be an additional tailwind, especially given we also know the Hispanic community in the US right now is not socializing as much as they were. Irrespective of sentiment and population, we expect RTDs to be a significant tailwind, driving both volume and price mix. We're expecting the market in North America to remain soft and challenged in fiscal 27, and there'll be slow and gradual improvement from there. John will share shortly how we're going to play in that market. EMEA, actually a tale of 3 EMEAs. It nets out to a +2 to 4% on value growth. GB, we expect to follow much more of a US trajectory, although that comeback is much more hard dollars in wallet than it is sentiment. Developed Europe, per caps have been soft for over a decade, actually, so it's much more of a price mix-driven story anyway. As affordability comes back, we would expect to see getting back to flat or slightly positive growth in developed Europe. The growth story here is emerging EMEA, so both the Middle East and Africa, where there's population growth, economic development, and emerging middle class. APAC, the market. We are expecting a return to modest growth over the plan period. The wild card here is really China. China, excluding Chinese white spirits, all these numbers here, excluding Chinese white spirits, has actually been down double-digit the last 2 years, so that's going to take some time to recover. But the rest of the region remains pretty resilient, and even Australia, where, as I said earlier, inflation and economic isn't necessarily great, immigration remains very positive. LAC, very strong growth opportunity. We're forecasting the market at 4 to 6%. Always some consumer wallet volatility in LAC, but we see very strong fundamentals. Population growth, economic development driving category participation, strong engagement in spirits, strong tailwind on RTDs. The growth, however, will be largely price mix. There's a huge amount of local spirit penetration in South America. So whether it's cachaça in Brazil, aguardiente in Colombia, local rums, etc., we're expecting trade out of local spirits, hence volume itself is flat, price mix driving the growth. India, another very strong growth story from a market perspective, again a +4 to 6 over the plan period, very similar reasons around economic development and population growth, and also, of course, a very strong and buoyant whiskey market, which will hopefully be further supported by the tariff reduction. If I pull all that together, regionally, what we're seeing is still a bit of divergence. North America will be a drag, as will China within APAC, but strong emerging market growth. I'm going to spend just a moment on premium beer, because that is our reference market for Guinness. However, as we've talked to you guys a lot about, we play pretty uniquely in Guinness, so we haven't built proprietary models to forecast the industry. We're taking IWSR and using that to inform what we think. There's some range by region, but overall, globally, a value of +1 to +3. But clearly with Guinness, we'd expect to outbeat that significantly. So if I pull it all back to where we started, we see strong growth across the portfolio where we compete. As we just said, premium beer, we're expecting to be +1 to 3% over the plan period for the market. Spirits, including RTDs, also +1 to 3%. Consumers continue to engage with our category across markets. We continue to expect and see growth. We plan to beat it. I'm going to pass to Christina, who's going to tell you how we're going to do exactly that.